Good morning, everyone. I'm Richard Kalordi, the Marketing Manager for HLB Manjard in Perth, and welcome to part 2 in the Financial Planning Tips for the Next Generation series, presented by Lauren Lockhart, who is a Certified Financial Planner at HLB Wealth, the Wealth Management Division of HLB Manjard in Perth. As corporate representatives of Paragem, Lauren and the HLB Wealth team work closely with clients on a number of investment strategies. And in this final webinar for the series, Lauren will look at the stock market and becoming a day trader, personal insurance, starting a family, preparing a will, and taking the first steps in planning your retirement. I also need to advise listeners that the information contained within this webinar is general information only and does not take into account your financial position, objectives, and needs. You should consider its appropriateness and seek financial advice before making any financial decisions. Also, if you have any questions at all during the webinar, please send them through via the Q&A box at the bottom of your screen and we'll go through them at the end of the session. Lauren, thanks once again for your time this morning.
No problems. Hi, Richard.
Hi, I'd like to start talking about the stock market first up. Now, as this webinar is targeted at the next generation, they may not have had a lot of exposure to the stock market. So just in very basic general terms, could you give us a broad overview of what is the stock market?
Okay, so the stock market is a place where businesses come together to, launch their business. They divide their company into many different pieces, which we know as shares. So investors are then able to purchase those shares to become what we call a shareholder in that company. So that effectively means that they own a part of that company and they've used their money to invest in that business. So the price that you pay for each share is determined by demand and supply, and the cost of a share is changing constantly throughout the day. And the stock market provides a forum where buyers and sellers can come together to trade on their ownership of a company. The aim, is that your piece of the company will increase in value and that you will make a profit by, playing on the stock market. Whilst demand and supply caused by investors helps determine the share price, there's other things that can impact the share price, and things such as positive new initiative or good news stories will potentially drive up the demand for a share, increasing the share price. And conversely, when companies experience things like bad press or scandals or things like that, that can reduce customer sentiment and drive down the share price. Nowadays, access to the stock exchange can happen in an electronic manner, so far gone from the physical yelling and screaming on Wall Street to try and buy and sell a share. It's much more available to your average investor these days. And these days, setting up a share account really is as easy as setting up a bank account. Your chosen forum will connect you with an online broker who will help you execute your desired trade. Meaning that you can trade shares from the comfort of your home, your phone, even your work computer, because of course you need to be trading while the relevant stock market is open. So there's many different stock exchanges all around the world in different countries, but the one that we'll be referring to throughout today will be the Australian Stock Exchange, and in short, that's known as the ASX.
Okay, brilliant. So, could you give me a bit of an overview of what type of companies are listed or what's listed on the stock exchange? I mean, we know that there are companies like NAB and Telstra and the big companies that we hear about, but what else is available on there?
Yeah, so like you mentioned, Richard, companies will list their businesses on the ASX. And as you mentioned, the big banks, mining companies, telcos, those ones that you're really familiar with are probably the companies that have been listed on our ASX for a long time, and they're quite big in nature. The reason that a company will list on the stock exchange is to help them increase the value of their business because it gives them a platform to gain wide access to investors that they otherwise wouldn't have had access to. So the newly invested money in a company will help them launch new initiatives and grow their business. So you can buy a share of your company, of a business. That effectively means that you own that, and you can of course do that through the Australian Stock Exchange. However, there are other investment instruments available on the stock exchange. I guess this has been as the ASX develops over time. And I'll just talk to you and the listeners today, Richard, about two other types. So first one that people may have heard of before is what's called an exchange traded fund, or we know them as ETF for short. In financial worlds, we love acronyms. So an ETF is a type of security that involves a collection of different shares that will often track an underlying index of types. So an index, for example, can be like the ASX 200. So that's the top 200 companies that list on the Australian Stock Exchange. So your one share in an ETF can represent multiple underlying investments. So opposed to having your one share representing one piece of a specific company, it represents a bundle of underlying companies. And it really is good for smaller type investors who want to get, I guess, a wider range of access without having to go and buy one piece of each different company out there to try and get a blend of different types of businesses. Because an ETF manager is obviously a fund structure, they do charge a small fee, and being able to, I guess, manage that type of investment option, but the profile is considered quite passive in nature. So generally, it's just going to be tracking a type of index. The managers aren't specifically making investment decisions that are their desired decision. It's more tracking something. The other option is what we call a listed investment company, like a LIC, we call it for short, or a listed investment trust, similar type thing. They're, I guess, a little bit more similar to a managed fund structure, and they're different that managed funds can't be listed on the ASX though, but these LIC type structures can. Unlike ETFs, which we just spoke about, a LIC manager will be responsible for setting up a fund objective and selecting the actual underlying assets held within their structure based on their expertise and the brief of that specific fund. So you can see here a manager's actually taking a more active type approach to what they're investing in, and they tend to set a guideline, and this active type approach means that they're obviously going to aim to outperform a benchmark, and in some instances they will, and then of course, as we know with investing, in some instances they won't. But sometimes of course, there is a management type of fee that can be attached to this sort of investment. And I guess these structures I've sort of explained in quite simplistic terms, that they can be a little bit more complicated when you look into them. But to give you, I guess, a brief overview of the nature of types of investments that are available on the ASX, these are a couple of options out there.
Okay, great. Now, would you be able to address some of the tax implications of investing in shares as far as the tax department goes or the ATO goes?
Okay, yeah, I think with a lot of newer type investors, they maybe think they get away with not paying tax until, of course, they lodge their tax return and then find out otherwise, because if you're making money, the tax office wants to know about it. They want their share, of course. So the tax isn't actually payable when you execute a trade. So you're actually going to need to wait until you lodge your tax return for that relevant tax year for the ATO to let you know how much tax is applicable on that investment trade. Now, when you're setting up your share account, similar to like setting up a bank account, you will be asked to provide your tax file number. And that's sort of, I guess, the link that feeds it through to your tax return. Or of course, when disclosing on your tax return, you should be disclosing any relevant information that's happened in that relevant financial year. Now, because you aren't provisioning for tax in a mandatory type manner, so think when you're receiving your salary, your tax is automatically taken about, so you don't need to worry about it. When you're looking at shares or investments, you need to make sure that you do have some sort of awareness around the tax implications of what you're doing, so you can provision for when that tax ultimately becomes due, so you don't, I guess, get caught out. Now, there's two ways that you can make money from shares more specifically. And the first is you can have a capital growth situation on a share. And that's where there's a capital increase in the share that you've bought. And you really only pay the tax on that capital increase when it's actually realized. So when you've actually sold it and you've realized the profit that you've made on it. So say you hold stock A and you purchase that for $10 and then you subsequently go and sell that stock for $15. What you've done there is you've made a $5 capital gain on that share. However, with capital gains, there is an additional step when you're an individual, and that is if you've held that asset for longer than 12 months, then you might be eligible for a 50% discount on that gain. So what that means with the $10 example is that $5 gain that you've made would be halved to $2.50, and that's subsequently what the tax will be paid on. Now, if you're unlucky enough to realize a loss, so that means that you've lost money on your trade, that $10 share you only sold for $5, you can carry forward that loss to offset future gains that you might benefit from. But you do need to make sure that that's in your tax return and you're following the process in order to realize that loss against future gains in the future. So make sure that process is done correctly. The other way that you can earn money on shares is through income. And what that's called with shares is getting a dividend. So these are paid out to the shareholders. So when a company, I guess, makes a profit, what they will do is pay out a portion of that profit to the owners of the company. And we know the owners are the shareholders. So you'll get your portion of profit based on the percentage of that company that you hold. And the frequency of that payment, of course, depends on the company. And also, I guess we can note that lots of companies allow you to reinvest any dividends you might have. So instead of taking the cash, you can actually buy more shares. To give you a bit of a background on how that works with tax, in Australia, companies pay tax at a 30% tax rate. Now, smaller companies pay at 27.5%, but in this example, we're dealing with the bigger type companies that are paying a 30% tax rate. So inside the company that you invest in, they will make money and then they'll have to pay tax. Then they will pay you your money and then you'll have to pay tax. So now in Australia, we don't pay tax twice. So I guess a simple way of explaining how this works is you will receive your dividend and then you'll also receive what's called a franking credit, which represents the tax that's been already paid on the profit that your portion has made. Now, when you lodge your tax return, they'll take into account that franking credit. And if your marginal tax rate, so the rate of tax you personally pay, is higher than 30%, then you might be required to pay a little bit more tax to get that to a level that's relevant for you. And if your tax rate is lower than 30%, then you might be at the benefit of getting a credit because tax has been overpaid on your portion of the profit there. So now that's a really simplified version of how tax works. I'm a financial advisor, not a registered tax agent. So we just dabble, but we don't actually do the tax work. But I would really encourage you to speak to your tax advisor about what the tax implications are of selling and earning in an investment share type environment, because the conversations definitely be best to be had up front.
Right. Okay. So you've talked a little bit about the capital gains and profits with regards to buying shares, but if a member of the next generation was looking to buy an investment such as shares, what are some of the additional points for them to consider?
Yeah, of course. I guess the very, very first question, and this is the planner coming out in me, is wanting to know, why are you wanting to invest? What are you trying to achieve? And what's the goal around that? And it's really important to understand why you're doing it, because it's going to help you figure out the end part, which is the solution to what you want to achieve. So you need to think about, is it that you're trying to save up for something? Is it that you're trying to build an investment portfolio that you want to produce an income stream in the future? So going, I guess, through this process will help you know your entry and exit points into an investment. It'll help you understand how much you need to achieve as a return to achieve your goal or the point of you making this investment decision. I guess it can help you figure out if the type of investment you should be getting into is income producing or is it capital gain increasing. So it's going to really help you set all sorts of parameters around what share, if that's what you want to invest in, what type of share and what that's going to look like. Other things you should be considering are around the cost of investing. So now, if you're constantly trading, are you considering the brokerage costs around doing that? The tax implications, I guess we've just touched on, of doing that, and the potential headache that you might be causing yourself or your tax accountant at the end of the year from, I guess, trading like a seasoned professional trader. So brokerage costs can be a dollar amount or they can be a percentage of a trade. But of course, the more you're trading, the more costs that are associated with it. So make sure you're considering those. Other things to consider are if you invest via a platform that completes some administration for you, there might be administration costs to consider there as well. Another thing to consider is, are you holding those assets properly? I guess it's easiest to set up an account in your own name, but is that the best thing for you? So if you're self-employed, are you potentially at the risk of being sued? Are your personal assets potentially maybe up for grabs if you haven't structured yourself correctly? Are you maybe earning at the highest marginal tax rate and your spouse maybe is a lower tax or a lower income earner? So maybe is it better that those investments are held with her to alleviate some of the tax payable? Is there someone in your relationship who has a large amount of capital losses that could be utilised by an investment portfolio gaining in value? So it's important to sort of think about whose ownership would be appropriate. Another thing that you can do is invest via a structure or an entity, for example, a family trust. So a trust structure might allow you to distribute any earnings between different beneficiaries, so family members such as adult children or whatnot. But it gives you a lot of added flexibility. So note that there obviously are associated setup costs with things like trust and end of year tax and compliance requirements, but they do offer some fantastic asset protection and tax strategies that you can utilize. So setting things up correctly in the first instance is a lot easier than trying to fix them if they've sort of been set up incorrectly in the first place. And so it's definitely worth having that conversation up front so you know that investment that you have for the long term, we're not going to have to play with it, manipulate it and change it if we find out it's not appropriate. Another thing is, have you diversified your investments? Now, it might have seemed like a really good idea to put all your money in a sector that's performed really well over COVID, and there are a few that have, I guess, benefited from a COVID type situation to this point, but that's a lot of eggs in just one basket. And if you have all your money in one company or one industry, or sector, so say for instance mining or something like that, it can mean that there's really high highs or it can mean that there's really low lows. So you're sort of at the bane of how that sector or that company operates. Diversification is the spread of risk. Now it can be done in many different ways. It can be done through investing in different companies, investing in different sectors, different asset classes. So blending your assets across different asset classes such as cash, fixed interest, Australian equity, international equity, property alternatives, that there's many of them out there, will help you align your portfolio to your appropriate risk tolerance. And I think this is something that should be considered for younger type investors because I guess it's tempting to jump into a brokerage account and buy up on all your Australian companies that you know really well, but are you really diversifying and spreading your risk in the right way for your risk tolerance and for what you're actually trying to achieve? So discovering your risk tolerance is something really important to consider. As a planner, what we do is we put you into, I guess, a profile, and that's potentially defensive profile or balanced or growth or high growth. And really what we're trying to assess there is the appropriate level of growth to defensive asset and trying to get that balance right. So growth type assets will be your Australian shares, your international equities, and defensive type assets, as you would expect, is your cash, your fixed interest, your type of investments. Now, I guess history shows us that growth type assets would tend to outperform defensive type assets, but they are a lot riskier and they fluctuate a lot more. And defensive assets, as you would expect, we maintain that capital investment pretty close to the line, and then we only have a tiny bit of increase in return, I guess, from there. So what we're doing is we're trying to test your comfortability around these profiles. So if you invested in a high growth profile and that meant that you couldn't sleep at night, that's obviously not the right way to go for you. Or if we invest you in a high growth profile and as soon as you see red on your account, you're selling, or you're calling your advisor and you're telling them to sell, maybe that wasn't right for you, because a more aggressive type profile requires a longer time frame, because we need you to be able to ride those ups and downs. So I guess we need to make sure you're comfortable before we execute something and then have to wind it all back because it wasn't right for you. Lastly, have you considered your time horizon, which I just mentioned? So getting rich quick sounds like a great idea, but usually investments will have an associated time frame. So shares, for instance, you'd want to be holding for the longer term. Generally, we say about 5 to 7 years, how long you should be holding them to be able to truly ride an up and down. And shorter timeframes are associated with things like cash or fixed interest. So if you need to pull that money in a year's time, you know that money's not there. We're potentially not having to sell when the market's really low, I guess losing all the benefit of investing in a more riskier type market. So as a planner, I guess our general rule is to invest for the longer term, but you really, really need to be making sure that you're considering all these things and your investment is actually fit for purpose.
Right. Okay. Now, you've just mentioned in that response COVID, and I'm glad that you did, because it feels like it's a hot trend at the moment amongst younger investors, because they do seem to be cash rich, and there is more of an interest in share trading. So what advice would you give to somebody before they decide to throw themselves into that world if they are cash rich?
Yeah, I completely agree with that. And I've certainly noticed in my peer groups, there's a lot more interest in shares and investing. And, you know, it's sort of pack mentality. Once one person starts to do it, we're all wondering what we're missing out on. So there's definitely an interest out there. And I think it's really important when you're trading on shares specifically is to do your due diligence and research on that company so that you're wanting to invest your money in. So to determine if it's a good buy, to make sure that you're making an educated financial decision when you're doing it with your hard-earned money. Other than that, you really need to be considering your entire personal situation to decide if this is the right thing for you to do. And this is, I guess, the exercise that you would go through if you enlisted professional type help. We would be discussing all those consideration points that we just mentioned in the last answer, and then making sure that that investment is fit for purpose. So as you mentioned, Richard, the markets, I guess, since COVID have been seemingly to be really, really attractive. We saw markets fall really significantly in March this year, and it would have looked like a lot of companies were operating at a discount. And in some cases, that's true. And lots of investors have made a really healthy return up to this point. However, it's really important to consider when we have a major market event, so things like COVID or this recession we are finding ourselves in, is that the market, as we know it, can change. And it's always best to be viewing the market with fresh eyes. So the landscape for different types of industries have really changed through COVID. And you need to consider if those pre-COVID share prices that you're comparing to when you're looking if you're getting a good deal or not, it might not be a reasonable comparison for a new share price. It might not actually be that company operating at a discount. It might be that company finding its new normal. We always hear that, the new normal share price post-COVID. But I guess here you need to also remember that demand and supply is determining share prices, and the price of something is only what somebody's willing to pay for it. So consider that in what I guess you're looking to buy out there. When these decisions, or when investors' decisions are made on things like mainstream form of advice, so things that come up on Facebook or maybe your mates at a barbecue, these, I guess, if they tend to hold a more than normal type of risk around that investment, they'd maybe form part in more speculative type trading. And this is where you almost take a gamble on the share, hoping that it'll improve in value. And often in these situations, investors are trying to buy in really low, sell really quick, really in a fast manner to try and, I guess, solidify the fact that they've made a profit on that. And in some cases it might work, but I mean, it's a very, very risky option. So definitely proceed with caution if you're going to take advice on a whim. And if you did want a portfolio around specific objectives and you weren't quite sure how to construct it in the manner that we've been talking about, so against your risk profile, diversification, all those things that we talk about when it comes to investment, this is where you might like to seek some financial assistance or help in regard to your investing. And I guess with all this being said, I do really just want to say that it's really wonderful that the next generation are really starting to be involved in their financial future, particularly when it comes to investing. I guess my advice is try not have an example made out of you. Try go in there making some educated financial decisions to try and get the best outcome possible for yourself. Now, there's so many benefits of starting an investment portfolio earlier in life when you're younger, because it's really going to give you the opportunity to be miles ahead of other people later on in life. So it is wonderful to see the younger generation getting into the share market. Maybe just making sure that you're getting in with an educated level head as well.
Okay, so I can see that what you're saying is that there is a segment of the next generation that is happy to invest in the stock market, but I would imagine that there would be a segment that is possibly intimidated because they feel like the stock market is just for mums and dads or bigger companies and not necessarily for them. So who would you say is the mix of people that does invest in the stock market?
Yeah, so there's definitely like your mum and dad type investors, or I guess your everyday people who are trading on the ASX. But like you mentioned, Richard, there's also these really big institutional investors out there. And these are like investment companies or super funds, for instance, who are buying and selling up big based on the funds that they manage within their portfolios. So they're investment companies potentially who run managed fund type structures. So these are where a managed fund will have a large sum of money. Again, it can be money from other investors as well. They pull this together and then they go out and use money, investors' money to buy. Now, these investment managers will purchase underlying assets within their pool of money, and lots of these will be shares that are listed on the stock exchange. So these, I guess, are the really big fish out there trying to buy up big when they see companies performing really well, or if they think there's a lot of value in a company. So I guess if you looked into an underlying managed fund, you would see that there are lots of the companies that we've spoken about today under their brief as well. So there's more investors, I guess, out there than just your mum and dad. There's those big players, I guess, looking to use the stock market as well.
Okay, now let's move on a little bit from stock market to personal insurance for the next generation. A lot of people from that segment would probably think that insurance is not for them. It's for people who are older and more at risk. Why do you think that personal insurance would be important for members of the next generation?
I guess before that, nothing sort of made me think of my own mortality more than COVID. It's kind of talked about every day, really, at this point in time. And I guess the relevant thing is that COVID has shown us that the truth is that none of us are immune from the COVID virus, and like none of us are immune from illness or accident and injury type things. So in Australia, we have a massive underinsurance problem when it comes to personal insurance, which is what you're referring there, Richard. A lot of people are really good at making sure that they have their home, their contents, and their car insured, but often a lot of people forget to insure themselves. So when we're talking or when I'm talking to a client, I'll often ask them, what is your biggest asset? And particularly young people always turn around to me and say, it's my home. And I mean, this is it's a huge asset when you're younger as well. But I think you found, if you really thought about it, your annual salary times your working life till retirement is a much bigger figure. So in fact, what your biggest asset is, it's actually your ability to earn an income. So insuring yourself is really important. So as a planner, what I talk about is personal insurance. So I guess what I'll do quickly, Richard, is just take you through each of those types of insurance and maybe why young people should consider them. So firstly, there's life insurance, and that covers you in the event that the person insured passes away. Now you can look at that insurance to cover yourself. So if you were to pass away, that you would want to leave a sum of money to your beneficiaries to help them financially continue on. It could be that you want to insure your partner because you know if something were to happen to them, it's going to put a lot of financial stress on you. You're going to need a safety net there to help you get through. You can even look a little bit wider. So say, for instance, you're in a blended family situation and your spouse has children with somebody else. You might want to insure that other person because you know if something happens to them, the children will form part of your family household, and that would again need some financial assistance to help you get by. So it's really about thinking about where the gaps are and how they can be filled in the event that somebody unfortunately passes away. Another type of insurance is known as total and permanent disablement cover. We know this is TPD for short. So this is a type of cover that pays out in the event that you have an incident where you become totally and permanently disabled. Now, this is one that's a really, really big financial cost to family. It's in this type of insurance, you need to cover things like rehabilitation, medical costs, modifications to your home. It's even just general changes to your life. It might mean that you now need to provision to how you transport your children to school. There's so many things to consider here, and it can be really financially devastating to a family if they find themselves in this situation. So it's a really good cover to cover the people in your family if something like that were to happen. Another type is trauma insurance, or sometimes it's known as critical illness cover. And this is one that is quite commonly claimed upon, unfortunately. What it is it pays you out on a specified illness. So here we're talking things like cancer, heart attack, stroke, liver failure, and it pays you out a lump sum if you were to suffer one of those events. Now, I know this has touched so many people's lives, and it really can be a financially stressful time for people. And it can really be a time where people want a lot more, I guess, financial freedom to be able to do rehab or be with their partner or be with the relevant person. So it's a really important cover to give you some options if something like that unfortunately happens. The last type is income protection cover. So I think this is probably one of the more well-known types of insurance. And what it is it covers your inability to earn an income. But what I like to think of it as is it's covering your ability to pay your mortgage. It's covering your ability to put food on the table or send your kids to school. So like I mentioned, your income is a massive part of your family in being able to support and grow and live. So income protection is vitally important in making sure that if that safety line was to stop, you have something in place to protect yourself and your family. And I find it critically important for those single income households in making sure that that lifeline is always there to some extent and covered by insurance. Of course, there are alternatives to insurance, and these are things like family, friends, savings if you're fortunate enough to have some, the government. But I guess as I'm listing off those, you're thinking there's a few strings attached and some subpar things around maybe going down one of those options. So I really like insurance because it provides you and your family with a lot more options. It's relevant for those who are in a couple in terms of making sure that your partner and your family are protected in an instant, but it is also really important if you're single as well. So it helps you be your own backup plan if something is to go wrong. Now, I guess there's the option to go back to mum and dad if you're fortunate enough to have that option. But again, maybe that's not something that you want to do. And again, when you do things like that, it can financially impact the other person as well. So I guess when you're young, you want to make sure that you're looking at these things and protecting yourself. Another reason to get cover out when you're young is we tend to have less ailments, less conditions, whether that be medical or physical injuries. The BMI tends to be a little bit lower. Well, I at least know in my case it was. So this type of insurance is underwritten at application. So what that means is when you go and apply for cover, they are underwriting you as you stand today. And provided you're obviously fully disclosing, they'll give you an assessment based on accepting your insurance at that time. So hopefully if you've not had any sports injuries or medical issues and stuff like that come up, you could be insured on what we call standard terms. So without any exclusions or any substandard things on your policy. And what that can mean is that later in life, if you do develop issues, if your back gets sore because of your job or things like that, it doesn't matter because you've already taken out that cover. They accepted you at the time that you went in and got that cover. So if you then suffer an injury that you can't work because of that, you can be paid out on that claim. The flip side is if you don't have the cover out prior to that point, and then you look to get cover later in life, potentially these little things that crop up could mean that there's loadings on your policy, which is like the insurer providing a multiple because of maybe the little bit of added risk that you are to them, or it can be things like exclusions. So for instance, we won't cover you because of an injury because of your back, because you've already got that pre-existing condition. So having cover out when you're younger is really beneficial because it might mean that you've got better terms than you otherwise would be able to get. And I know of a lot of older clients who are so fortunate because they took that cover out when they were younger, because they can see their peers now trying to get cover, and it's a lot harder game to play in, and potentially maybe they can't get that type of cover. So it's really, really wonderful to have cover set up and underwritten at a point in time when you're younger. The other thing that young people can do is where you want to hold your insurance for a really long time is you can look to set up your insurance policy under what we call a level premium structure. Now, this is a way to structure your premium that when you take it out, you might pay a little bit more, but you're not at the bane of the really big age increases that come with holding insurance. So as you'd expect, when you get older, you become a little bit riskier. Your percentage based on statistics of claiming increases. So there's always an age increase in your premium, which can tend to make them unaffordable when you hit later in life. And I mean, that's when you really need the cover. A level premium increase will just mean that it slightly increases as you go. You start out maybe a little bit higher, but you don't have the big age-based increases that otherwise would be on what we call a stepped premium structure. So setting up that level premium structure on the outset means that you've put in that a little bit more initially because you really want to hold that policy for a long term and you want to make sure it's affordable for the full term that you want to hold it. So there's just a couple of things as to why looking at it when you're younger is really beneficial.
Okay, now talking about protecting your family, which you did touch on, what are some of the financial considerations that a person should think of when they start a family or before they start a family?
Yeah, so obviously a really exciting time for a family. As I just mentioned, insurance is definitely something I think younger families, particularly when you're starting out with a family, for something for you to consider there. Other things is really understanding your budget. It's extremely important to make sure you're understanding both your pre-baby, post-baby budgets, because it's obviously going to change. But I guess when I do the exercise with clients, don't automatically think that your costs are maybe going to go up, because you'll find that your lifestyle sort of changes a little bit. So it is a really interesting exercise to go through what your budget's going to look like before and after. I am cautioning people at the moment, considering your COVID budget may, I guess, be a little bit warped at the moment, where people maybe aren't able to live to the full extent that they were before. Make sure that you're looking at a budget under normal circumstances. And then, of course, make sure that you're leaving a buffer. It's really important to have a bit of give and take in any sort of budget parameter that you set for yourself. It's really, really important, particularly understanding this if you're going to move from a double to a single income household. Often happens, obviously, when we have a baby, a really young child that somebody needs to stay home and care for in the initial period. I personally think that's the biggest financial impact on a family. It's not the child's pram and dummy and things like that. It's actually the fact that you've moved from a double income to a single income that, I guess, causes that squeeze for younger families. Then, of course, when a person does return to work, we need to factor in things like childcare costs and whatnot. So I guess budgeting throughout the exercise is a really great thing for a family to consider. The other thing is considering the time out of workforce. So obviously, we've talked a little bit about how that's going to impact your take-home pay, but there's other things you should be considering there. And they're things like the impacts on the super situation of the person who takes some time out of the workforce. So I guess it's really good for families to consider how they maybe could be contributing in some sort of fashion to their super whilst they're not working, and having their mandated employer super contributions being paid into their account. And there are some really good government benefits for those who move into a lower income to start looking at contributing to their super and paying attention to their retirement, even whilst they're having that little hiatus from work. And speaking of that, there's lots of different scenarios why someone might have a hiatus from work. It can be a parent caring for a child, or it can even be a child caring for an elderly parent. So there's lots of situations, COVID, for instance, why we might be having a little hiatus from work. Maybe consider what that means to our super as well, looking at an overall financial position. The other thing you can look at when starting a family is the government benefits that are available to you. So these come in the form of family tax benefits and obviously other things like maternity and parental leave. Explore your eligibility to these. Some of these options are automatically given to families who have a child, and then some of the options are also restricted by family income amounts and things like that. So it's really important to do your research and know upfront what's available to you, and obviously apply for them if it is relevant for your situation. Other things for those super organized parents is that maybe you want to consider funding setting up a savings plan or something to fund their schooling costs. Because I'm telling you, if you want your children to go to a private school, as a planner, I see it quite a lot, they're quite pricey. So again, starting out really early is going to be a really great thing for your family. It could be that you want to set up an effective savings plan to be able to grow this money for them. You might like to consider investing these funds to help boost your savings to be used for your child's education. There's other structures out there, such as investment or education bonds that can be used for children's education, which might offer tax benefits to you. So you can certainly start to think about maybe some investment options around saving for their schooling if you're really on the ball.
Okay, now we've only got a couple minutes left, and I've got two questions I wanted to ask you. I'll ask them to you as one question. With regards to preparing a will and estate planning, could you tell us why these are important for families? And also, it might seem early, but if someone is thinking about planning their retirement from a very early age, what are the important factors? That's probably a lot to cover in 2 minutes, but see what you can do.
Okay, Richard, thanks for the test. I guess in terms of a will, we know that that's a legal document that displays our wishes of what we want to happen when we pass away. For a mum and dad, it might seem quite that they just want the the money to go to the survivor, and then the survivor will look after the family. But a will can also allow you to stipulate what you want to happen in the event that you both pass away. And I think in that situation, you'd want to set out your intentions of what's happening there. I guess to let you know, a common misconception that I hear from younger people is that I don't need a will because I don't really have many assets. But I think you'll actually be surprised. Once you look at your super or any life insurance you might have personally or in super, it can end up actually being quite a big estate and really give something people to fight over. So sometimes it's best to just display your intentions from the outset. Another reason a will, I guess, is on a lot of younger people and young families' minds is because they wonder what will happen to their children in the event that they and their partner pass away. So now how you can nominate somebody is via your will. You'll nominate what's called a testamentary guardian. So this will be someone who you want to look after your children while they're under the age of 18. You can also nominate, I guess, a backup person, and that's somebody who can take over in the event that your first choice is unwilling or unable to care for your children. If you don't do something like that, what will happen is that it'll go through the family court process and you'll have your relevant family members put their hands up, and then that's how it'll be decided upon. So maybe you'd like to make that decision upfront. Quickly, to just touch on the retirement part of what you mentioned there, Richard, is for younger people, I really encourage you to look at your super funds. If you're one of those people that don't open the mail, please stop. Pay attention to what you have, because it really is your cold hard cash. It is your money for your retirement. So have a look at it. If you have multiple super funds, maybe a look at how the multiple fees are affecting that. Look at your risk tolerance. Is it appropriate? Is it invested correctly? And I guess recommended type investments. Consider the insurance that you hold. I guess my point to younger people is super is our government's preferred form of retirement savings. And if you've noticed, the pension age is creeping up a little bit higher all the time. And that's really because the government wants us to provision for our own retirement. So it's definitely something you should be looking at. The way the government's doing that is obviously we have the 9.5% mandated super contributions being paid for us. Now, this is going to increase in the next few years, which is wonderful. But it is said that if you wanted to live the way you do today in retirement, you would need to consider more appropriately about an 11% contribution rate. Now, obviously, there's factors that can increase that make that correct or not correct. But I guess it's just important for young people to consider that maybe that 9.5% isn't enough. And then maybe the fact that you take a little bit of time out of work or things happen could be impacting your retirement savings as well. So I always encourage people to think about their super, think how they could contribute, how they could help their current situation to benefit their future situation. Yeah, so just definitely look at your retirement. You can do some really good things now, so you can really benefit later in life.
Excellent. Great. Okay, that brings us to the end of this webinar, Lauren. Thanks once again for your time today.
Of course.
For our audience members, if you would like to get in touch with Lauren directly, you can email llockhart@hlbwa.com.au. And these webinars will also be available on the HLB Man Judd YouTube website. Great. Excellent. Thanks, Lauren.
All right. Thanks so much, Richard. See you later.
Have a great day.
You too.